With mortgage rates stubbornly perched above the 7% mark, the real estate landscape finds itself grappling with fresh challenges. Home sales have descended to levels reminiscent of the last decade, a situation reminiscent of the year 2011. These observations stem from the latest economic and housing forecast by Fannie Mae's team of economists. In their September report, they underscore the seriousness of the situation, reiterating their earlier anticipation of an impending mild recession in the coming year. The recent resilience of the new housing market, which surprised many during the first half of 2023, owes its vigor in part to the limited availability of existing homes. However, it seems that this momentum may be taking a pause, as the commentary suggests. The forecast from Fannie Mae's economic pundits remains consistent, as they uphold their earlier projection of a modest economic slowdown in the opening half of 2024. While the Federal Reserve persists in its efforts to curb inflation and navigate the economy toward a gentle deceleration, these economists express concern over the sustained unsustainable level of personal consumption compared to incomes, with the full repercussions of tightening monetary policies still rippling through the economic landscape. Anticipating the trajectory of the Consumer Price Index, Fannie Mae's experts foresee figures at roughly 3.1% for the headline and 4% for the core measurements by the close of 2023. Subsequently, they predict a further tapering to 2.4% and 2.5% in the following year. Turning to the realm of real estate, these economists envision the total U.S. home sales for 2023 to hover at 4.8 million, marking the slowest pace since 2011. Their crystal ball suggests a slight uptick in 2024 to 4.9 million. Adjustments have also been made in the mortgage origination forecasts, with expectations shifting from $1.6 trillion to $1.56 trillion for 2023 and from $1.92 trillion to $1.88 trillion for 2024. Nonetheless, a cacophony of mixed signals within economic data continues to muddy the immediate outlook. The pivotal question of whether the economy is embarking on a gentle deceleration or sliding into a mild recession remains unanswered. Fannie Mae, in a recent press release, asserts that a modest economic contraction is the most probable outcome, attributing this to the persistent consumption outpacing income and the ripple effects of prior monetary tightening. They also note a perceptible deceleration in inflation, coupled with signs of a cooling labor market, but highlight a significant divergence between GDP and gross domestic income over the past 3 quarters. Meanwhile, their expectations point to a retreat in credit card transactions and retail sales in the data for August. Despite the real estate market grappling with formidable challenges in the form of mortgage rates soaring above 7%, the realm of total home sales appears to be relatively shielded from significant downside risks. A notable shift is observed, where life events are increasingly driving these sales rather than discretionary factors. Moreover, the prevalence of cash transactions remains robust, as noted in the news release. The opening half of the year witnessed a remarkable resilience in new home sales, attributed in part to incentives provided by homebuilders to counteract rising mortgage rates. However, the trajectory ahead seems poised for a modest contraction, with the Fannie Mae economic team citing the influence of an elevated mortgage rate environment and a recent dip in homebuilder confidence. Doug Duncan, Fannie Mae's senior vice president and chief economist, reflected on their earlier prediction made in April 2022. Their foresight then was that the combination of diminishing stimulus effects and tightening monetary policies would lead to a mild recession in the latter part of 2023. This prediction was partially based on the expectation that the scarcity in housing supply would prevent a steep decline in production. Indeed, housing production has defied expectations. Yet, the sustained impact of fiscal relief measures related to the pandemic and accumulated household savings have extended the duration of robust consumer spending beyond initial projections, providing unforeseen bolstering to the broader economy, Duncan explained. The current outlook points to a gentle downturn in the initial months of 2024, grounded in the assumption that consumers will gradually ease their spending. This shift is expected as these funds are exhausted, aligning more sustainably with the relationship between spending and income. Despite this financial caution, households maintain confidence in their employment status, even though their sentiments about the overall economic landscape are less optimistic, according to Fannie Mae's recent National Housing Survey. the majority remains cautious about the prospect of home buying, with mounting mortgage rates and housing prices weighing heavily on affordability. The survey findings gain further validation from the fact that home sales have plummeted to levels akin to those observed during recessions. This predicament arises from the glaring scarcity of existing homes available for purchase, coupled with the formidable affordability hurdles that potential buyers face. Furthermore, the persistently high proportion of new homes in comparison to the overall real estate market, along with a significant number of first-time homebuyers opting for new properties, underscores the ongoing housing supply conundrum. It is anticipated that the entire housing market will maintain its sluggish pace well into 2024, largely due to the unwavering stance of the Federal Reserve in holding interest rates steady in the face of inflationary pressures. Intriguing insights and forecasts have been unveiled regarding the forthcoming year in the real estate market. These revelations shed light on the challenges and opportunities that lie ahead. If you're eager to explore further and discover strategies for finding lucrative real estate deals, simply click on the video displayed on your screen. Thank you for joining us, and here's to a successful and informed journey in the world of real estate investments.